Hi, my name's Wayne Pommen. I'm Chief Revenue Officer at Affirm. Affirm is a buy now, pay later company that's in the United States, Canada, UK, and soon beyond. People choose Affirm to get very clear, transparent financing options when they're making purchases at the retailers they know and love, allowing them to pay over time and avoid credit card debt. I was previously the CEO of a company called PayBright, which was Canada's first buy now, pay later company, allowing people to shop at their favorite retailers and pay over time with clear and transparent terms. In 2021, we were acquired by Affirm, which was a larger US player, and I've been Chief Revenue Officer there ever since.
Last time you were here was last summer, and it was during Tech Week as well, Toronto Tech Week. But you were, I think, speaking on stage for Tech 2.
Tech 2, Tech TO. Yep, yeah, exactly. With Alex Norman.
Right. And back again at Startwell. Have you otherwise been here before?
To Startwell?
Yeah.
This is my second time.
Wow.
And I'm very impressed.
Okay, thank you very much.
I'm going to have to use this for meeting space. It's massive.
Please do. Please do. Now let's talk about how you'll use it for meeting space. You're at a company called Affirm.
Yes.
Okay, so for people outside of Canada, maybe outside of North America, explain what that is. Let's talk about the company.
So Affirm is certainly North America's leading buy now, pay later company. We don't always love the term buy now, pay later because it has certain connotations and it's shorthand for things, but if effectively we allow people to buy something today and pay for it over time. The company started in the US market. It was founded by Max Levchin, who was one of the PayPal co-founders, along with Peter Thiel way back when.
What year is way back when?
So PayPal was sort of like 97, 98.
Yeah.
And so Peter and Max were founders of PayPal. And at some point along the way, they joined forces with Elon Musk with X.
You have to bring him in.
Came together, and then that turned into the going public and the sale to eBay, et cetera. So that was Max's, not his first company, but his first big company.
Right.
And then fast forward a number of years, he founded Affirm in 2012.
Okay.
With the idea that there's a way better way to do consumer credit. That's much more fair, that's much more transparent, that doesn't have a lot of the downsides of credit cards and store cards. So started in the US, now in Canada, now in the UK. 27 million active consumers, which is they've done a transaction with us in the last year.
Okay.
On average, they do 6 or 7 transactions a year with us, and we're close to about $50 billion a year in purchases that we have funded for those customers.
Oh, that's interesting. See, I thought that customers would use it far more frequently.
So it's growing steadily. So I think we're at 6.7 transactions right now.
Yeah.
But that's more like doubled in the past couple of years. It just sort of keeps going up and up.
Yeah.
As we, number one, add more merchants to our network. So that's the sort of original go-to-market, right? You can find us on Amazon. You can find us on Apple Canada, Costco.
Shopify is an option.
Yeah,
right?
with Shopify, where we power the Shop Pay installments product. Yeah. In total, we have over 500,000 merchants that offer us as a payment method. So that drives, ubiquity, availability. And then we also have direct-to-consumer products in the United States. So we have a card, which is not a credit card. It's a hybrid debit card, BNPL card. You choose. And we also
BNPL is buy now, pay later.
Buy now, pay later. Yes. Yeah, exactly.
You don't like the phrase, but you have the acronym down.
All right, it is a shorthand that we use because generally speaking, people know what it means.
Right.
If you'll permit me a slight double click on that.
Yeah.
BNPL has been most associated with this pay in 4 model. So you buy something today and you pay in 4 biweekly installments.
Oh, okay.
And that a lot of people, when they think of buy now, pay later, they think of that. We do have that product, but we all have many other products as well. So allowing people to pay over 3 months, 6 months, 12 months, 24 months, matched to the size of the transaction. Sometimes it's interest free. Sometimes it's interest bearing, depending on whether the merchant wants to subsidize it. So there's a lot more to our product. And so sometimes we don't like the simplicity of BNPL because it has a very narrow connotation. So that might be more than you bargained for.
No, as much information is helpful. Because I think the other thing is, a lot of our audience is Canadian, right? Though a lot of people watching and listening will be all over the world. In America, this whole ecosystem of finance is way more robust, I think, or there's so many operators in this kind of like short-term credit world compared to Canada, right? So I guess everything from like how people earn their money and cash their paychecks to then finding out other ways to kind of leverage their financial capacity. The whole thing seems to have been so evolved in America in the last couple decades. Paint the picture of like the Canadian difference. You know, why is it different if it is, and how is it changing?
Yeah. A couple things. One is that Canadians have very deep and strong relationships with our Canadian banks. And so it's a heavily banked population. People adopt the product suite that the banks have.
Right.
I think Canada is the most, if not one of the most, if not the most credit card penetrated populations in the world. So something like 90% of people over 18 have a credit card.
Huh.
And again, it's part of those relationships mainly with 6 banks. And so that's a big difference. And I think it historically has provided less space or less scope for innovation because of the sort of stranglehold those banks have had on those customer relationships, and sort of a chunk of the population not needing to frankly look elsewhere for sort of basic functions. That's one piece of it. I think another piece of it is, again, just sort of the dynamism and robustness of entrepreneurship in the US generally. You know, for every one company that's started here, there's 10 there. I'm making that up, but that type of thing, right? But
population dynamics, sir.
yeah, exactly.
Makes sense.
But look, I mean, there is a lot of innovation happening in Canada now. We do have some significant breakout companies like Wealthsimple and Neo and others.
Yeah.
So it's coming. And then I think a lot of people have looked to the open banking regime coming as a means of sort of kickstarting some of that innovation. So we'll see. We've been waiting a long time. We're almost there.
Right.
Yeah.
Yeah. I mean, this is the thing. Everyone in fintech tells me like it's kind of this Christmas moment. You know, they're just waiting for Santa to drop the
yeah
the presents by the tree.
So I've been in fintech in Canada since 2015.
Yeah.
And at all times, open banking was imminent. And so if you had based any sort of business plans around waiting for open banking, it would have been a very bad bet. But seems like we're finally getting there.
More imminently imminent.
Yeah, exactly.
Okay, so let's roll back and
Yeah.
we'll come back to Affirm and what you're seeing, in Canada. But let's take it back to 2015, right? How'd you get into finance stuff?
Yeah, so maybe just to go a little farther back.
Sure. Where were you born?
Yeah, I'm from Victoria, but we'll skip a little ahead.
Okay.
I spent a long time in school. I have a PhD in international relations. I wrote a thesis on NAFTA. I didn't know what I wanted to do. And I spent a lot of time rowing as well. Like I was on the Canadian national team and rowed in university. But didn't know what I wanted to do when I grew up. So after I finished the PhD, I went and worked at Bain & Company.
Okay.
This is in London.
Yeah.
And then some years later, moved back to Canada, went into private equity at a firm in Toronto called Torquest Partners.
Okay.
And partway through my time there, I developed, along with a couple other folks, kind of a specialty in financial services and in particular non-bank financial services. The thesis being there are some pockets of financial services that the banks don't have a stranglehold on.
Sure.
And there you can have a real business and make good returns. And so I was going around looking for those types of businesses to invest in.
Like used car financing.
Well, auto lending, subprime auto lending is actually one of the niches that the banks don't do that
The
well.
Shylock businesses.
Yeah, we try to stay away from
Excuse
those.
the phrase.
Yeah, but there are some like those out there, unfortunately. So in the summer of 2013, I spent the entire summer trying to acquire a point of sale lending business in the home improvement space. So again, point of sale lending is...
That sounds so confusing. A point of sale... Say it again.
I'll explain. So point of sale lending is where you're offered credit at the moment you're buying something to make that purchase more affordable.
Right.
Right. So let's suppose
like
you needed
mezz financing.
Well, I'll explain more. So let's suppose you need a new furnace.
Yeah.
And the guys come to your house and like your new furnace is $6,000 and you're like $6,000. And they're like, but you can pay over 3 years.
Yeah.
Possibly interest-free if the manufacturer of the furnace is willing to subsidize that for you.
Sure.
And you go, great. And you sign up for a payment plan. The manufacturer, you're happy. The manufacturer is happy. The dealer is happy.
Yep.
That's point of sale financing.
Okay. I thought you meant for the price of a home.
Oh, no. So home improvement, like home improvement being things that you would buy for your house or add on to your house.
Sure.
So summer of 2013, I tried to buy a business. We at TorqueWest tried to buy a business that did that. And I learned all about how it worked and the funding of it and the margins and the technology behind it. And I thought that's actually a pretty cool business.
Mm-hmm.
And one of the most appealing things about it is the distribution model where because you're working with dealers and merchants, they're bringing you to the consumer.
Right.
And so you get this really accelerated distribution. And I thought, that's cool. We should try to find more businesses like that.
Mm-hmm.
And I came across one called HealthSmart Financial Services, but it's very small.
Yeah.
And it was a division of a larger healthcare chain.
Okay.
And it was providing, again, that point of sale financing model, but not for furnaces, for healthcare products and services.
Okay.
So like pay over 6 months or 12
What's an
months.
example of something that would cost that much that people need?
In healthcare?
Yeah.
Hearing aids, dental treatments. You could put veterinary in there. Mobility.
Dental treatment?
Dental treatments.
Like someone needs a root canal.
So you could have like
They need
some
to finance that
unplanned
root
multi-$1,000 dental
Yeah.
treatment. You might
Yeah.
need financing.
Okay, so
Or-
whenever there's like an emergency prompt to make a purchase.
Emergency, or it could be something like, let's suppose you were getting like Invisalign for your teeth, or you were going to go to a med spa and get, a $1,000 treatment. That was the type of thing that HealthSmart did. Put it like anything that was healthcare but private pay in Canada. That's what they did. Again, it was very small, right?
Right. Yeah, that's super
5
niche.
people. And so I met with the owners, and it was like, hey, this is not really a deal for our private equity firm. It's too small. But we stayed in touch, and a year later, this is in 2015, we connected again, and they were like, look, we have this little HealthSmart point of sale business. It feels like there's something more we could do with it. We don't have a CEO. It's just sort of bolted onto the side of the bigger business. Long story short, I got involved.
Okay.
I invested, sort of became an equity partner in the
Privately,
business.
though.
Privately.
Okay.
I became the CEO, sixth employee,
Okay.
and we spun it out. This is in sort of December 2015, January 2016. And we can get into the whole story, but that business is what became PayBright. In the long run, became Canada's first buy now, pay later.
Okay, let's get into it. So the majority of owners, right, that kind of brought you in, did you buy them out?
No, so they stayed invested.
Okay.
This
was a health like a medical company, or what? Who was it?
Yeah, it was a weight loss chain that's now gone out of business.
Like Jenny Craig or something.
Yeah, it's a competitor to Jenny Craig.
Okay.
And but we spun out the of HealthSmart and sort of grew that on a standalone basis.
Yeah.
So I invested, worked out an equity deal with the owners, became CEO.
Yeah.
And we went on from there. So the first year, 2016, we just focused on healthcare because the company hadn't really focused on, in my opinion, that much growth.
Right.
And so we doubled the business in the first year, but it was still very small. We grew it from like 6 to 12 million a year of loans, of transactions that we were funding.
Sure.
And toward the end of the first year, we had learned a couple things. One is that the Canadian private pay healthcare market is so fragmented,
Right.
that once you have the biggest dental chain, the biggest fertility chain, whatever, you get this super, super long tail of tiny little businesses, and the ability to go and sign them up for your service gets really tough, or it takes forever. And the second thing we realized is that no one was providing any sort of point of sale financing for e-commerce, like buying stuff online.
Yeah, which was picking up.
Right. And it was very common in Canada to go to the Brick or go to Best Buy and get financing, right? Like you want to buy a big TV, 0%. What happens? You would stand there for 15 minutes and fill out their forms
Right.
and get a card,
Sure.
get a store card. That doesn't work online. No one wants to take 15 minutes online to fill out this application, and it hadn't even been tried. And so we thought what you should do is have a simple installment loan that you can get quickly in checkout.
Yeah.
And our platform was an installment loan platform. So we adapted it for e-commerce, and we launched as Canada's first buy now, pay later, again, e-commerce installment transactions in the summer of 2017.
So that was quite a quick innovation cycle to build out the software side. Okay, there's a couple things that already have me scratching my brain. One, what was the kind of built-in equity in that business that you kind of joined as the CEO? Is there any regulatory kind of framework around this that they had they'd already kind of done the legwork to get ahead with, or not?
Yeah. So, I mean, some of the basics were in place. So we had, working software platform that was working for like an in-store use case,
Okay.
right? So the dental, et cetera. There were paying customers. There were the basics of regulation and compliance were in place.
Okay.
But again, at a very small scale.
Because it doesn't sound like, is it something that is regulated though?
It is.
At that,
It is. I mean, non-bank lending in Canada is not that heavily regulated. Like the most important things you need to stay on top of are sort of consumer protection law.
Right.
So how are you disclosing your financial terms, your interest rates? There's obviously a maximum interest rate in Canada. Those are sort of the most important things. The company was not live in Quebec at that time. Quebec has a separate regime that we
Okay.
had to go to later.
Sorry, what is it? Do you know it off the top of your head? Like, what's the maximum allowed interest rate in Canada?
It used to be 60%. Now it's 35. We don't
Hot
get
diggity.
to the max.
Yeah.
But for years and years, it was a 60%.
Interesting.
Yeah.
Okay. Back to the story. So they had all of this kind of like baked in, let's call it, like they had a leg up that you could lever into other industries.
Exactly. So
And the e-commerce refactor on the software side, you said that it sounds like it was 6 to 12 months.
about 6 months.
Okay.
And again, it was sort of MVP in 6 months. It was not all the bells and whistles that we got to later. But what we did is in early 2016, when we realized this is the way we wanted to go, we went and sort of pre-sold to a couple of merchants. So we went to Casper, the mattress company,
Right.
and Endy, the other mattress company, because in other markets, they were starting to take advantage of this type of financing.
Okay.
And so we went to them and said, hey, you should try this for Canada. And they were like, yeah, we agree. It's not available, right? It's like, no, we're building it. You want to be the first customers. And like,
Awesome.
okay. So we launched with them in, I think it was like August 2017. And with a very simple plan, like the MVP was like 6 months interest free, where
Okay.
they would subsidize the interest for the customer. And it went from there. We started signing up merchants left, right, and center. We went to Wayfair, went to Samsung, and that's what turned into like a 4-year, really fast ramp
Yeah.
of the business.
From the get-go at that point when you rebranded and launched with these new kind of e-com scale partners, how important was it to you, or is this something you learned along the way, to have brand equity in the promotions of the service with the purchase and with those vendors?
Yeah, that's a good, important question. So you do want to build a brand. You want customers to be aware of you. You want them to recognize you in checkouts.
Yeah.
You also want there to be no confusion about who is offering the service.
Right. Is it
Because-
owned by the vendor, or is
right.
it you as a service provider on top?
Basically, there are very, very few merchants these days who want to be in the financing business themselves. They want to sell whatever it is they sell, and they want somebody else to handle the financial services. And so you don't want any confusion there, especially because we have to be in touch with the customer afterwards, right? They need to go onto our website, be in our app to say, okay, I've got 4 payments left, or if there's any problem, they need to be in touch with us, not the retailer.
Right.
So that needs to be clear.
Yeah.
And then in the long run, what you want to do is have your own brand and build your own sort of two-sided network of consumers and merchants, and generate a flywheel effect where the more merchants you have, the more attractive you are to consumers, and vice versa, which is where Affirm is now, that we're into the millions of users.
Right. So in terms of like speccing on these kind of like promotional relationships, speccing the presence of your word mark, iconography of your brand in promotions, is that something you had leverage to kind of stipulate early on? That's amazing.
Yeah.
Because you were really solving a problem for them.
Yeah,
big
exactly. And, we did have the benefit of the basics of the model having already been established in other markets.
Right.
Right. So, Affirm was already live in the US, and there's others in other countries. And so it was starting to be understood how you would present and sort of merchandise the offer, right? So
Yeah.
you would be a choice of payment option in the checkout. And then you might also be on a product display page, your king size mattress, full price is $1,200, monthly price is $100. By Affirm or by PayBright. That's really important. What we call up funnel messaging is important for the customer to understand that offer before they make a selection.
Sure. Yeah, because otherwise, if they have to figure it out after the fact, when that monthly payment comes out of their credit card or whatever, weekly or daily, I don't know what it is, then they'll freak out on you.
Yeah.
What's the okay? And then the other side of it is the back end of the business, right? So who underwrites these purchases, and how do you do it programmatically in a way that you can take on millions of customers?
That really is the heart and soul of the business. That's the secret sauce. And so how Affirm works is every single transaction, millions and millions of times a month, is individually underwritten. So it's not like a credit card where you apply for the credit card, you get approved, and then you've got $5 or $10,000 to spend. Every single transaction is individually underwritten based on the data points we have about you, your payment history with us, that particular transaction you're making it, what you're buying, where you're buying it, which allows us to make a very fine-grained credit decision, which allows for sort of super accurate underwriting. Like at any given time, we can get the optimal balance of approval and risk management. And that's sort of the underpinning of the business. And it also ties into another critical part of the business, which is the capital side. So all these loans have to be funded, right, to the tune of billions and billions of dollars a year. And so we have lenders that lend us money or buy our loans, and the performance of the loans has to be exactly what people are signing up for. And so our underwriting model underpins the value that the consumer gets, the performance that the merchant gets from offering us,
right,
and the capital partners in terms of the performance of the loans that they buy.
Right.
So without excellent advanced underwriting, this business does not perform very well.
Oh, for sure. And in the beginning, where did you go for capital?
So back in the PayBright days, none of the big five banks wanted to take our phone call. We were too small, right?
Yeah.
We got the first sort of line of credit from Canadian Western Bank.
What is Canadian Western?
They're like an Alberta-based bank, and they had a division.
Credit union or a bank?
They're a bank.
Okay.
I think they've been acquired by National Bank now.
Okay.
If I'm not mistaken. But they had a division that specialized in lending to lenders. And so this group, would go into small lenders like us and figure it out. And they had expertise in how you lend to lenders, which is not expertise that everybody has.
Yeah.
Then we grew a little bit more, and we added another facility with Equitable, EQ Bank. They call themselves Canada's Challenger Bank, but they were a great partner to us. They had a track record of supporting fintechs. And then once we got a bit bigger, the big five started to return our calls, and we set up a facility with CIBC shortly before we sold, before we were acquired by Affirm.
Okay.
And now Affirm has a capital program that's on a completely different planet in terms of its depth and sophistication, dozens of loan buyers and lenders.
Well, this is it's something, okay, in that seat just like a week ago, Sam Safe from Purpose Capital.
I watched that, yeah.
Oh, you did? Okay.
Yeah.
So he was saying, right, in that episode, he was telling me we were talking about like more personal finance, not necessarily like business finance and B2B finance. But yeah, how difficult it is, even me as an operator, I know it, to go to a bank to get capital for any reason in Canada. And there's a certain kind of like minimum threshold that they need to see involved in a deal to be able to make it worth underwriting the risk of a new client relationship or whatever. So did you find that, you went looking for these capital partners? What did you feel like they were looking for in terms of the minimum amount of, would it be, I guess there's a few factors, right? Because it's about like, how much money do you need in what period? How will that grow? So how will you as a client account will grow with us? And then at the same time, there's about the transactional volume of, recapping. How does that work?
Yeah. So in our business at that time, they would lend you money against the collateral, which is the balance of the loans that you have made. So
pre-existing, not a future.
Yeah. So existing. So how it would work back then, it was like an asset-backed loan with a borrowing base of loans that's constantly refreshing. So let's suppose I have $5 or $10 million of loans that I'm owed.
It's basically a mortgage and a line of credit.
You could say that. Yeah, revolving asset-backed line of credit. So I have $10 million of loans that customers owe me. and they will let me borrow, let's say 85%. So that day I can borrow $8.5 million from the bank. Next month, my loan balance has gone up to $11 million. Now I can borrow 85% of that number.
Yeah.
So that's how those simple loans worked back then. And what they were in terms of deciding whether they would lend us money, they want to know, is the $10 million of loans or $11 million going to be worth 10 or 11? Because if a bunch of them don't pay back,
right,
that's not good collateral. The 15% that they're not funding is meant to be the safety margin, but in a bad scenario that could vanish, and then they're have lent against thin air. And so the due diligence that they do is on your track record, like how well have these loans paid back in the past? Have you made any major changes to your underwriting policy that we might not want to sign up for? Do you have a credible team around this? How does your underwriting actually work? What data sources are you using? So most of the due diligence is around that. So one of the advantages we had was that when I got involved, we weren't starting from a blank sheet of paper. We had the HealthSmart history. There was a couple of years of loans to look at and say, okay, well, yes, I see how these pay off, and your delinquencies are low, your defaults are low, and so sure, we're happy to lend 85% against your book, but we're going to be coming back every quarter to look again at everything to make sure you're not, deviating from what we underwrote.
Okay.
So,
now, what's the other side of the story for merchants?
In terms of how it works for them?
Yeah.
Yeah. So the reason this whole industry has taken off the way it has, from basically nothing 10 years ago to now like hundreds of billions around the world, is the consumers love it, but they would have only known about it if the merchants loved it too.
Right.
And so merchants see significant benefits to like conversion, average order value, and ultimately sales growth by offering this, by giving customers a new form of credit.
So it's incentivizing additional purchases that they wouldn't otherwise have brought on.
You can use the word incentivizing. I would call it, if you're shopping and now in a way that you couldn't before, you know exactly what you owe every month. You can understand very clearly how it's going to fit into your budget. You know when it's going to be paid off. You know exactly what the terms are very transparently. You'll have the confidence to make a purchase that you might otherwise have waited a week for or not made. And so the results merchants tend to see is conversion goes up and AOV goes up. Average order value goes up. And those results have been obvious from the beginning, and they just sort of keep getting better for merchants. And so that's why you can now find us on Amazon and Shopify and all these other merchants. It just keeps spreading as a payment method that merchants think that they should offer.
Yeah.
So that's what gets us in front of the consumers.
And of course, the payout to the merchants is instantaneously from you upon purchase.
Yeah, typically next business day.
Okay.
And again, if the merchant has decided to fund an offer like 0%, we will hold back some of the purchase price in the form of a merchant discount rate and that'll be how they fund it. So let's suppose the merchant's going to pay us a 5% fee to fund a 0% offer. I'm just making up a round number.
Sure.
Instead of, for every dollar of the purchase, we might fund them 95 cents on the dollar.
Right.
Customer pays us back $1, and that's how we earn the MDR.
Yeah, super interesting. Okay, so you started growing very quickly in Canada. This is also an interesting time, isn't it? Because 2017-18 was also on that kind of like merchant financing and e-com growth upward trend, where like Clearbank came out of nowhere. Shopify was about to open their kind of
Shopify
like
Capital.
Yeah, Shopify Capital. So e-commerce was growing into the pandemic. And you said that at what year was it that Affirm called you?
So I can get into the whole acquisition story.
Yeah.
But we were acquired in January of 2021.
Okay, so leading up to that though, how were those years for you guys in 2017, 18, 19, 20, leading up to the pandemic?
Yeah, it was basically crazy growth.
Right.
So we had, and you have to remember, when I got involved with HealthSmart, I didn't even think about e-commerce. Like this is all something that
it was all new and interesting. And
right.
Like, what can we do with this?
We didn't think we were going to do this. And so then all of a sudden this was like this super high growth thing.
Yeah.
Starting mid 2017 through to 20, we were just growing like crazy. And like signing up merchants as fast as we could. We were frankly getting a lot of help by what was going on outside Canada, because the same thing was happening outside Canada. And so Canadian merchants were looking for this product, and we were more or less the only game in town.
But also for our audience, I think it's worth calling out the fact that the amount of merchants was also growing exponentially in e-commerce at that time.
Yeah, exactly. And so we got some big merchants like Wayfair and Samsung and Hudson's Bay, but we also had hundreds and thousands of like Shopify merchants, WooCommerce, BigCommerce, all these platforms where SMBs were growing.
Yeah.
So it was sort of both ends of the spectrum. So it was very rapid growth. It was extraordinarily exciting. It was also incredibly stressful because it's a tough business to scale quickly operationally, because you need the capital, you have to be underwriting safely, you need the tech to support the scale of the merchants, right?
Right.
Like Black Friday is not for the faint of heart in this
infrastructurally,
business.
right?
100%.
Yeah.
And then servicing, right? You got to have all this customer service stood up.
Yeah.
And your customer numbers are ramping, and so it was super exciting and super stressful for like 3 years in there.
So with that growth, what was your head count, do you think, kind of 2020?
It was in 2020 it kind of got about 200.
200 people.
Yeah.
And in 2017?
So when we launched the e-com product, we probably had 25.
Wow.
Something like that.
That is crazy, because that becomes a job in its own right, just like managing the organizational structure and behavior, right? And everyone was based here in Toronto? Or?
Yeah,
Okay.
Everyone was in office downtown Toronto.
Where was the office?
We were on King Street, 220 King. And then in 2019, we moved into the across from Roy Thompson Hall, the RBC Tower at Simcoe in Wellington, where we still are. We still have that office. Yeah.
Okay, so things are going crazy. You pulled out all your hair back then.
Yeah. A full head of hair in 2015.
And then where was, I guess, your headspace, and how did that acquisition happen? At the right time, perhaps? Yeah. So I always say there was no plan to sell the business. Things were going great. Just notwithstanding the stress, it was like very exciting. We saw like a long potential runway. But what started happening in sort of 19 and 20 is, number one, the space got very, very heated. There was a lot of, especially outside Canada, Affirm, Klarna, Afterpay were raising billions of dollars. It was getting very, very competitive for merchants. And it was starting to spill over into Canada, and merchants' expectations were being set by this sort of arms race outside Canada, number one. Number two, those players, those like scaled up fintech players, were going to come to Canada. And so we sort of saw this coming. And what then happened is these players realized that if they're coming to Canada, they should maybe consider buying the market leader, which was us. And so we started getting some outreach. From Klarna, which is a European player that we happen to have a partnership with, actually, from Afterpay. One of the Canadian banks actually was interested in potentially acquiring us. And so this was sort of after the initial shock of the pandemic, and then things were actually going really well for us during the pandemic. Everyone's at home buying stuff.
Yeah. So we were totally scared initially.
Like, we might lose our jobs, so let's just, use this.
Yeah. Well, we were super
system.
worried, right? Like, we thought people wouldn't be paying their bills. They'd stop shopping. Our banks would like pull their credit lines.
Yeah.
But then it turned out we were a massive beneficiary of COVID, right?
Amazing.
People were at home buying the types of goods that we sold, like home office equipment and furniture and all this stuff.
Right.
So anyways, by sort of April, May, let's say, of 2020, we'd had these inbounds. It was clear that the industry was getting very hot. And there was a moment where we were sort of in demand as the Canadian leader.
Of course. And
so I went to the board, like the other shareholders and a couple other board members we'd picked up along the way as we'd raised money. And I said, look, we should probably, this wasn't the plan A, but we should probably like consider this. We should look at this, because there's a chance that we could miss this moment and then be pummeled and frankly, we were sort of small and behind these other players, right? We were not well positioned for
they could turn on a territory with their means, like by flipping a switch.
Yeah, and they could buy merchants and all the rest, and it would have been hard for us to compete. And so we thought, look, if there's a moment where we're very attractive as an acquisition candidate, it would be irresponsible not to at least consider it.
Sure.
So then one thing led to another. We ran a very small process. We got, I guess, 4 or 5 bids. This is in the summer, fall of 2020. Affirm sort of rose to the top, which we were very excited about because we had huge respect for Affirm, for Max Levgen, who we talked about, for how their products are designed, the sort of tech forward nature of the business. Like we thought they were very strong. And ultimately their offer kind of rose to the top and just made sense for everybody. And so that deal closed in January of 2021.
Okay. Interesting. And then what did it look like for you? This is quite a roller coaster that you've been on. What did it look like for you for the rebrand and then integration into the kind of parent company?
Yeah. No, then we moved on to the next chapter of the roller coaster. So the first thing that happened was 2 weeks after the acquisition, Affirm went public. And it was a blockbuster.
But of course,
IPO.
you anticipated this.
We knew that was probably coming, but we didn't know for sure.
Oh, so okay, that was all hush hush. Like they didn't disclose.
Well, we knew that they were working on it, but with an IPO, you never know until you know, right? Like if conditions have to be right and the timing has to be right.
Goldman has a bunch of buyers lined up. It's like it's got to be next week.
Yeah, well, as you know, like when the market turns, your IPO can be put on ice. And so, anyways, it happened. It was mid-Jan of 2021, and that was just this head-spinning experience, right? It was very exciting for the Affirm team that had been working so hard all these years, and it was a really successful IPO.
Wow.
So that was the first thing, but it was still COVID. And so that entire first year, I didn't see anybody from Affirm in person, not until November.
Wow.
And so we tried to integrate the companies entirely remote, which was interesting.
Right.
Not the easiest experience, but we got there.
Okay.
We integrated pretty well. It was actually really fun to work together on a really big launch in Canada, which was the Apple Canada launch, where we launched as like the exclusive partner for the Apple stores and Apple online. So iPhones, iPads, that was like a really big deal for us. And we worked hand in hand, PayBright and Affirm, to deliver that. After the first year or so, the integration had kind of settled down. And then I started thinking, okay, what do I do next? Some of the team were still there. Some people had opted out, as sometimes happens after an acquisition. But we had a 2-year earnout.
Okay.
And so I thought I'll do my 2 years, and then probably it's going to make sense to move on. And I'll spare you all the fine detail, but around that 2-year mark, Max asked me to become the chief revenue officer for the whole company.
Affirm Global.
Affirm Global, yeah. And that's now 3.5 years ago. So been doing that ever since.
My God, what twists and turns. When that particular role, why specifically revenue?
So there was probably an opportunistic element, which is that our prior chief revenue officer left. So there was an open role. Okay. And the other thing is, my profile as a CEO is I'm not an engineer. I'm not a computer scientist. I was more, an all-rounder and sort of more business finance background.
Sure.
And I was always pretty involved in some of the revenue side stuff. So selling to the big merchants, working with the channel partners. And so even though I wasn't like a professional CRO, Max.
Yeah, who is, honestly?
Yeah. Well, there are some out there, right?
These days. There's only Kyle Norton. He's the only one,
Yeah. But you see these guys posting on LinkedIn about all their, frameworks and this and that for go-to-market. I'm like, I'm not an expert in that stuff. But I've always been okay at building relationships with merchants and selling. And so Max said, hey, I think you can do this. And so, I didn't think the story would continue on this long, but it's been super fun. It's such a great company.
So wait, do you live here in Toronto still?
Mm-hmm. Yeah.
Okay. So when you took on the role, what did it mean for you in terms of learning how the rest of, how the American operation works and seeing if is it something where territorially there's nuances, or is it a kind of a blanket operation for the whole country out of like Manhattan or something?
First thing, we're still a remote first company.
Oh.
And so, we get together a lot. We have a lot of offsites. We travel around, but for the most part, we're spread out across almost 50 states and 10 provinces.
But with offices?
We have some offices. So we have Toronto, San Francisco, New York, Chicago, increasingly London sort of has an office because we're expanding to Europe. We can get into that.
Yeah.
And so the people that are near the offices use the offices.
Okay.
But otherwise they get used for offsites, right? So
Nice.
teams are encouraged 3-4 times a year to get together somewhere.
And did you guys, coming out of COVID, reconfigure real estate to play that function?
Yeah. Yeah, we've downsized. So like give an example, in San Francisco, we used to have like 4 big floors of a building. We now have like less than 2.
Yeah.
And the savings go into more offsites and other ways to get teams together.
Yeah. But otherwise the core function where you have these spaces is for people to have focused work or meet and play ping pong and stuff.
Oh, it's focused work.
Okay.
I mean, today in the Toronto office, there's, I don't know, 25 people, and we have lunches on Tuesdays and Thursdays.
Okay.
It's not a ping pong type of a culture.
Right.
But, it's nice to go in, but there's no obligation to go in.
Man, the day I rolled our ping pong table onto the street and put a sticky that said "free, take me," I felt so liberated. I actually did.
Those days are over.
It's like,
yeah.
I mean, we have like video game machines downstairs and stuff. There is still like fun things for people to do here. Obviously, that's now our function. But yeah, the ping pong, it takes up too much square footage, man.
Yeah.
That's very interesting, though, that there are these hubs, but you've kind of focused in the corporate culture on giving people places and time to come together and actually have fun together.
Like I'll give you an example. We had a hackathon, 2 hackathons in the past few months. One was in the New York office, one was in the San Francisco office, completely packed. Tons of people flew in. So that's a great way to use the office space.
Yeah.
The main focus is not necessarily day-to-day work, although if you live in the Bay Area, great, go into the office. If you live in Toronto, come into the office.
Right.
But we leave it pretty flexible.
That's amazing. Okay, let's talk about the macro picture. You dropped that you guys are growing into Europe. Mm-hmm. On a global perspective, right? 1, where's the opportunity for Affirm? And 2, what are the underlying consumer trends that are enabling that, that are ubiquitous, if they are, across the world?
Sure. So markets vary widely in, exactly how consumers behave, regulation. There's different cultural traditions and legal traditions and all of those things.
Yeah.
What are the universal elements? Human beings want and need to buy things. Mm-hmm. In almost every market, there is a concept of credit.
Yep.
Right? I want to buy something today, but I don't want to pay for it all today. And the biggest thing that we lean into is there is increasing desire for transparency, fairness, understanding of what you're signing up for. And this is a foundational principle that Affirm was founded on, which is, and this goes back to Max and founding the company, which is that when he looked at the consumer credit industry, he saw how poorly aligned industry practices were to consumers' actual needs. And the canonical example is like how credit cards work or how store cards work. Great offers, super convenient, accepted everywhere. But when you start to unpack how they work, the picture gets a little darker, right? So if you think about your credit card, it's accepted everywhere. That's great. Mm-hmm. But if you don't pay it off at the end of the month, you'll carry a balance. On that balance, you will pay between 20 and 30% interest. If you haven't paid it off at the end of the following month, you'll then be paying interest upon the interest. And you don't have to make a payment other than the minimum payment. And what's the minimum payment? $10. Right.
It's less than that accruing interest.
Right. And there's also things like late fees and whatnot.
Yeah.
So something that is a super convenient payment instrument has this financial instrument attached to it, which has a lot of downsides.
Definitely.
And a substantial percentage of Canadians are carrying a balance right now. And a substantial percentage of those are paying only the minimum payment every month. So they are paying vast amounts of money ad nauseum for years when they were just trying to buy a couch, right? And then if you think about it, what are the incentives of the bank, of the lender? The best customer is someone who never truly defaults, but pays vast amounts of compounding interest. That's a good customer for them. Mm-hmm. But is that what the customer wanted to do, intended to do? Absolutely not.
Nope.
And the other side of all this is what is all that interest going to fund? It's funding, obviously, the lender profits,
Yeah.
but it's also funding points for the segment of the population that does pay their credit card balance off every month. So there's literal wealth transfer from the people who find themselves carrying a balance to, those of us who don't, which
Right.
is a sort of source of unfairness. So Affirm is designed to do away with all of that.
Okay.
The idea is you're going to make a purchase. You have a choice of paying it over 3 months, 6 months, 12 months. We're going to let you choose. We're going to show you what that's going to cost you.
Mm-hmm.
You can never owe more than what it says because we don't have late fees. We don't have compounding interest. We don't have deferred interest. And the day, what your monthly payment is, and the day that it's done, and that's it. That's the promise. That has massively resonated in the US and Canada and the UK with us so far. 27 million people transacting on average 6.7 times a year and growing. We think those principles extend all around the world. So we are in the process of expanding to Germany, France, Netherlands, and Australia in the next near period of time.
Yep.
And we'll keep going from there. It's going to be a multi-year journey, but we think some of these principles are fundamental no matter where you go.
No, I like that. I like the transparency driving the consumer trust in the brand, right?
100%.
Plus, it's kind of interesting because if people know the brand and they start becoming a multi-use customer, I think the platform innovation is just like sitting there, like the opportunity for platform innovation, right? So in that area also, where do you see the product evolving in the next, let's call it, couple of years?
Sure. So, originally the business started entirely with these merchant point of sale relationships, right? So being in the checkout of a Shopify store or Amazon or what have you.
Yeah.
And about 3/4 of our transactions still originate through those. But what's the fastest growing part of our business is our direct to consumer offering. So the Affirm card that I mentioned.
Right.
So let's say you used Affirm 5 times at a merchant.
Now underwriting can enable you to borrow more. Oh, sorry, not borrow, but borrow.
That's
more.
borrowing.
Yeah.
These are loans.
Yeah.
You're borrowing money. But you might say, hey, I'm using Affirm a lot. I really like it. I'd like to use it kind of everywhere. I'm going to sign up for the Affirm card. We'll mail you a card, and it'll also be an electronic or a digital version in your app. And that will work everywhere Visa is accepted. And you can use it as your debit card, pay now, or you can take those purchases if you want in the app, select whether you want to pay it over 3, 6, 12 months. We don't even have to be integrated with those merchants for the card to work. So that's very popular, very fast growing, currently only in the US. I'm hopeful that we'll expand that around the world. So that's a kind of a big area of product innovation for us. And then the next insight we've had, and this is also one of Max's children, is in the US, there are hundreds of millions of debit cards.
Yeah.
Right? There's thousands of banks issuing hundreds of millions of debit cards. What if we could, so you as a debit card holder from your bank don't need to go get an Affirm card if you don't want to. We'd love it if you did, but you don't have to. What if we brought the functionality of Affirm card to the card you already have by working with your bank and putting the key functions in your banking app that you already have?
Sure.
So this is something that we're in the process of launching. It's called Affirm Edge. And that's the goal, partner with banks and bring this functionality right to the debit card.
Amazing. And you still have that brand relevance. It's not like you're an OEM vendor providing a service that could be swapped out by the bank down the road for their own internal kind of innovation.
Well, what we have found is most banks aren't interested in going through the legwork of developing a really high-performing BNPL product, right? They're good at mortgages. They might be good at car loans. They have tons of other things that they're working on. So when we come to them and say, hey, you can have a best-in-class, scaled BNPL offering with all of our merchant offers as well that we can bring into your app, let's partner on this. We'll run all that stuff for you.
Is that an American phenomenon or a Canadian phenomenon?
So far, just US. That'll be the first market for it.
No, I mean the receptiveness and that perspective. Because I would think that Canadian banks want to own a little bit more of
We'll
whatever
see. We haven't tried it in Canada yet.
Yeah.
What you've seen in Canada is most of the banks have developed this sort of like post-purchase BNPL. So you go into let's say you're at BMO, you have a BMO credit card, you make a purchase, it's a couple $1,000. You can go into your app after the fact and choose to spread that over time in exchange for...
I've not even seen that.
Yeah, I forget what BMO calls it.
I mean, I don't bank with BMO, so
Yeah.
that's probably why I don't
I
know
think
about.
CIBC has one. I think RBC has one. But you can spread it over time in exchange for a fee.
Okay.
I have no idea how big those are for the banks. It doesn't really compete with us.
Right.
So they've done that part of innovation like within their credit cards.
Yeah.
But they haven't done anything sort of on the debit card side.
Okay, two questions. One, let's get this out of the way because I'm in business. A lot of our audience are entrepreneurs and founders and stuff. What's the opportunity for you to move into servicing business clients?
So we do a little of that today. It's definitely a growth avenue that is there that we haven't pursued that aggressively yet. We are on Amazon for Business. So if you're a small business making a purchase, you can pay over time, and we'll underwrite you and service you as a business, not as an individual. But we see more coming there. So we recently launched, we're very excited, with Intuit QuickBooks for their invoicing platform. So you ever got an invoice from like a contractor or something like that through QuickBooks? Yeah. So you can now pay your invoices over time.
Okay, I see.
Currently, we're only doing it for consumers, but down the road, I could imagine us doing it for businesses.
Yeah.
So there's a lot more to go at there. Like the opportunity to provide capital to small businesses is vast.
Yeah, it's huge.
We really like the idea of it.
And spend management is such a big issue for
Absolutely.
SMBs, you know?
Absolutely. And so we think there's an opportunity there. We think we could be good at some of those things. There's just been so much wood to chop on the consumer side that we haven't devoted that much to it yet.
Man. Okay. And then the other question is really about competition and how, Visa, MasterCard, the credit cards are viewing you guys.
So in the payments ecosystem, the question of competition is a bit convoluted. Visa is more of a partner than a competitor, right? So they are the network behind the Affirm card. They will be involved in the Affirm Edge product that I talked about as well.
Okay.
And so we are a partner of Visa's. Now, obviously, they also enable credit cards that we compete with to some extent.
But it's a diversification strategy for them to support you.
Yeah. I mean, they run network rails that can be used in any number of ways. And so we're one of the ways. And so, I think I don't think they would see us as competing with them. Right.
Yeah.
We see competition as, broadly speaking, credit cards, certainly store cards, which was sort of a more legacy form of point of sale credit. And then there are others in the buy now, pay later space as well.
Okay. It's very interesting. Now, also from the consumer side, has there been a want for people to earn points in some way? This idea that extra value.
Yeah. The idea of loyalty rewards always comes up. Our philosophy on it is that the more you use Affirm, the better it should get, but by making the product itself better, as opposed to lounge
trinkets.
access or something, right? Yeah. So the more you use us, you might find that your spending power with us goes up. Your approval rate gets better.
Yeah.
You might find you're getting more 0% offers, which consumers love. So that's our version of rewards and loyalty, in context in the product itself.
Okay.
It's working really well. We don't think we need to try to compete on some of those other sort of ancillary type benefits.
Yeah, that makes sense. Focus on the value. Because you want sensible clients, customers, that understand what they're getting into.
We think all of our users are sensible because they've chosen us. And again, back to the point I made at length a minute ago, we think they're choosing us and using us again and again because of the fairness, the transparency, the understanding. We think they're making a smart financial decision if they're choosing to use us instead of, adding to the credit card balance.
Yeah, and to that end, what can you say about in Canada, what you're seeing across the board of, from Affirm users in terms of typical purchase price that they're using the service for? Actually, that's a starting point. Yeah, what are people? I know it's probably a range of things.
Yeah, it really spans the spectrum, right? So we have everything from high-end furniture and electronics all the way down to much, smaller kind of everyday purchases on Amazon or what have you, fashion, apparel merchants. It's really spreads a very wide range. In theory, depending on approvals and everything else, you could make a purchase anywhere from $35 to $20,000 with us.
That'd be the cap, 20K?
Yeah, it's sometimes higher.
Okay.
That's not that common,
Yeah.
but it's possible.
Yeah.
And the idea is we just want to serve a really wide spectrum of merchants, and B, we want to serve consumers' needs up and down the spectrum as well. And we have different products to fit it. Like, again, you might make the pay over 4 biweekly installments for the $100 purchase. That's not going to work for the $10,000 purchase. That's where you want to pay over 24, 36 months.
Well, it's also about kind of consumer readiness to spend online at certain purchase points. Like, forget about the serviceability of the contract with you or any other loan or lender, let's say, but the total purchase price. Like, we've seen this here in our business at Startwell, where we used to take all sorts of different payment methods, right? And it'd be great. Yeah. We'll fill out your form and we'll be an authorized vendor and then pay me on terms. Send it to the bank. Oh, you can't send it to that bank. So we'll set up another bank account and all that drama until we double down on like maybe earning about 80% of the revenue, which costs a lot of money, via credit card. It's just easier for me to manage, even though the cost is very high. Mm-hmm. But I don't want to hire someone to manage inbound, and that's the relativity in my mind, right? So the trade-off is worth it for the ease. But then what I learned is, of course, there's so many different. Now talking about a business purchaser or spender, I should say. Our customers aren't necessarily ready to spend with a credit card. We've seen an evolutionary step in the last couple of years with the, what do you call it, like virtual credit cards, mm-hmm. where now they can have authorized spend limits raised, right? Yep. The CFO can punch it into the computer.
Spend management for corporate.
Yep. Yeah. But it still points to the human who's doing the purchase. Like, the staff get anxious sometimes when they're booking something. What we've seen is more than a 10K clip. 5K is the first spend clip, and then 10K is the second one, and then beyond that, they need multiple people to kind of play in the purchasing decision. So that's part of the question too, right? Is like, how ready are customers able to commit to a certain amount? Where's their threshold for being on the hook for that value that they're spending?
Yeah,
whether it's now or later.
I think the logic that we all go through when we're making a purchase applies, right? Like,
can I afford it?
That I want? Can I afford it? Does this value for money? All the things. But in our case, we're helping them better understand, can you afford it?
Right.
Right. Because the terms are clear, the monthly payment's clear, the end date's clear. So that's our role. Mm-hmm. And when you, again, provide that confidence and transparency to customers, you help them decide, should I buy this today or not? And again, like, going back to what I was saying earlier, we can't benefit whatsoever if a customer falls behind, because we don't have the late fees. We don't have the revolving account like a credit card.
Yeah.
If a customer falls behind, that's bad. That's only bad for us because we're on the hook for the loss. And so we want to underwrite them really accurately. We want them to totally understand what they're signing up for, mm-hmm. because there's no incentive for us not to. That's so fundamental.
How have things changed from the PayBright days to the Affirm days now, looking at where your optionality is in sourcing capital to underwrite the business or finance the business?
Yeah, the scale and the availability is just a completely different planet, right? Back in the old days, you're raising a few $1 million of equity and you're hoping to get a $10 million bank line. We're now a public company, a profitable cash flow generating public company. So the equity markets are wide open to us, although we haven't had to raise any for a while. And on the debt side, like funding the loans, we have something like, north of $15 billion of sort of capital available through a variety of different financial structures that we use to fund the business.
Yeah.
And the track record of the company is excellent in terms of the performance of those loans. And so one of our great strengths is our ability to attract capital.
That's nuts, man. It's amazing how many times a week I hear the word billion.
Yeah. Well, it has been, exciting for me, right? So remember I talked about the getting started with Health Smarted, which became PayBright. The first year when I joined, they had just done less than 6 million of loans and Canadian dollars.
Right.
And we're about to do 50 billion, US. And so the scale of everything is just, so different, but so exciting.
Let's draw some lessons for our audience who may be founders or business leads of some kind looking for inspiration in your story. So that zero to hero question, for you, what do you, when you look back or you're giving advice to other founders or anything, what do you think about this idea of both kind of committing to an industry and or company product that you believe in, and then being prepared to learn through kind of like the journey it takes you on?
Yeah, I mean, I guess I would say that a few things there. If you're gonna work really hard for years at something, you better believe in what you're doing, right? And that is one of the exciting things about our industry. We strongly believe we're delivering a better form of credit. We strongly believe we're making people's lives better by doing it our way than the old way. And that's a sort of a very motivating principle at Affirm. I do think sort of on your question more broadly, the longer you're in a space, the more context you have. There's just like a compounding return to that, right? In terms of your ability to operate, to make decisions, to benefit from what you learned in the past, to leverage relationships in that space. It almost, Max always has this saying: "It doesn't get easier; you just go faster." But I think that's true.
I like that. That's great.
He's a big cyclist, so he likes these sort of cycling metaphors. The other sort of general advice I have is like, you've got to just stay in the game. Like you've got to just stick at what you're doing. And yes, you need some luck and great teammates and all of those things. But if you're like in a space, believing what you're doing, and you stick at it, you're going to get somewhere. And it may be that thing where like, it doesn't feel like that much at first, but the compounding over 10 years can really take you places. So.
Oh, absolutely. When you look back at a decade and it doesn't feel like it's been that long, that's a good place to be.
Yeah.
That's a great place to
100%.
be. Let's talk about Canada for a second, because this is a territory that you've remained in personally, even as you've taken on a larger responsibility with a global organization. What does being in Canada mean to you as a citizen, a place to live, and then also operating a company that's in other territories from here? How do those things relate for you?
Mm-hmm. I mean, I definitely live here because I want to.
Yep.
I'm here for a reason. I spent 10 years outside the country for college and, started working in the UK, but was like very explicitly wanted to come back to Canada and be part of it. I think it's a great country, grew up here, all the things. And I want to see us succeed. And I think we've been in a patch where we're underperforming our potential, and want to see more entrepreneurship, want to see more growth, want to see more people, benefiting from opportunities. And I think we lost our way a little bit, as we've been talking about a lot around here, but I feel
how so to you? How's Canada lost, or how did Canada lose its way?
We've definitely fallen behind in terms of, economic growth.
Yes.
I really get very troubled by some of the brain drain trends that we have going on. I understand why it's happening, wage differentials and opportunities, availability of capital. But I feel like even compared to the immediate pre-COVID period, even Toronto's kind of lost its, tech mojo a little bit, but I think we can bring it back. I really do. I think we will. But that's important to me. Like, I want to see that happen for sure. I want there to be many more PayBrights and Shopify's and Wealthsimples and Neo Financials and Borrowells or what have you. I think it's so, so important. And there's no reason why we can't do it.
There isn't. And I think this is something that's really important that keeps emerging in these conversations that we're having on the Startwell podcast of late, this year especially, is the want for business leaders to work together. Whether it's for, inspiring each other or otherwise finding out paths to actually help each other's businesses succeed. And I feel far too often in the last decade plus maybe that I've been back in Canada 2 decades now. Yeah, since 2005. So in the last couple the first of those 2 decades was it still felt like we were a community, and then in this last decade that's been stratified from my perspective. And the kind of nationalistic sentiment across the country has deteriorated as Canadians perhaps have forgotten why we have all chosen to live here. If you were born here, you've chosen to stay here. And if you migrated to this country from somewhere else, or your parents did, again, it's like a decision you can own.
Yeah.
And the question is like, why in the last little while people have forgotten why they should have a sense of ownership and what they need in their own life to have a sense of ownership in our common destiny. And that takes conversations. It takes people being able to reach out to each other, learn from each other, work together, right? So I see that as well, that the tide is shifting, at least in the business community here in Toronto, which I can speak for, where people want to do stuff together. And that's really heartening. What do you think on that note, though, kind of Canada's identity is globally? And even from your lens, in the Affirm business, and maybe even talking about your staff in the US and elsewhere, what do you think people look from outside of Canada at Canada as today? What is brand Canada, do you think?
That's a good question. I don't know if I have a pithy answer. And there's so much noise now on social media.
Yeah.
And sort of we're all in our own information bubbles. It's hard for me to generalize and say what is exactly the brand or what do people think.
Anecdotally, you could talk to your staff elsewhere. What do they think of the Toronto? Do they look at the city or the country as being something specific? Do they want to travel up to check it out?
I mean, yeah, sure. I mean, we have, an annual executive team meeting here. We have offsites here. I mean, I think generally speaking, our Canadian team is regarded as super talented, nice people, hardworking people, thoughtful people, an important part of the company. About 10% of the company is based in Canada. I don't know how to give you a more broad-based answer that wouldn't take us into some serious philosophical or speculative realm. But I mean, the country has a lot to offer. We have the most educated workforce as a percentage of the, in terms of university degrees and whatnot in the whole world. Some of the most important AI advances in the past decade happened here, right? And at the University of Toronto, and all the people that were around that, many of whom are now in the Valley. Like, the talent is here, the know-how is here. We have some capital things that we need to work on. Some community pieces we need to work on. But I think we can do it. It will always be a challenge, a wonderful blessing and a challenge being next to the United States, right? Being next to the biggest market in the world, the most dynamic economy in the world, is a huge blessing that Canada has benefited from for years. It also does mean, though, that we have to constantly sharpen our own value prop of why people should stay here and build companies here and work here.
Right.
And I think we were doing okay at that for a long time. I think the balance tipped against us maybe in the past 5 or 6 years.
Pandemic,
some breaking of connections, some, maybe differences in business conditions and whatnot. But I'm excited to see it snap back.
Nice. Awesome, man. It was a pleasure spending some time chatting.
Hey, we could have gone on for another hour.
Right?